Get ready for the biggest moves in global finance. Amazon is lining up Swissy's debut as Alphabet targets its first yen deal. This is a massive strategic shift, signaling how major tech players are diversifying their funding across international markets to fuel their next big expansion. We dive into what this means for the future of global commerce and tech investment right now.
Tired of dropping your phone or struggling to hold it with one hand? The PopSocket's Pop Grip gives you a secure grip, works as a phone stand, and even lets you swap the top for a fresh new look. Simple, useful, and perfect for everyday phone use. Click the link in the comments to grab yours on Amazon.
Next up, Alphabet is preparing its first yen-denominated bond offering, and this is huge for the AI race. Sources tell us this potential deal could reach several hundred billion yen, and major financial institutions like Mizuho Financial Group, Bank of America, and Morgan Stanley are lined up as bookrunners. We break down why this move is so significant for financing massive AI capital expenditures. The stakes are incredibly high because Alphabet is turning to yen bonds as the AI race becomes a balance sheet contest. This move shows that funding is evolving. AI is no longer just a feature budget, but the physical foundation of the next computing era, requiring massive, long-term capital. We explore how this global debt strategy changes the competitive map for everyone in the tech industry. Finally, Alphabet is tapping yen bonds to fund global AI and an ambitious India hardware push. This combination highlights an emphasis on scaling AI beyond just software and cloud services, looking toward deep on-the-ground capabilities in a massive growth market like India. Don't miss these critical developments shaping the future of technology and finance. Stay with us for the full analysis. Global Capital reports that Amazon is positioning Swissy for a debut as Alphabet pursues its first yen-denominated deal. This development signals a significant move in the international technology and financial landscape, suggesting a potential cross-border collaboration between the two tech giants involving the Japanese currency. Further details regarding the specifics of the proposed deal and the role of Swissy remain undisclosed at this time, making this an anticipated development in the ongoing strategic negotiations between Amazon and Alphabet. Alphabet is preparing to launch its first Japanese yen-denominated bond offering, with sources indicating the deal could amount to several hundred billion yen. To manage this potential senior unsecured issuance, the company has mandated Mizuho Financial Group, Bank of America, and Morgan Stanley to act as bookrunners. This move follows a recent debt raise of nearly $17 billion this month through euro and Canadian dollar issues. Concurrently, reports indicate Alphabet has increased its 2026 capital expenditure forecast to a range of $180 billion to $190 billion. This activity occurs within a wider trend, where major technology firms are ramping up spending on artificial intelligence infrastructure, with industry analysis suggesting large tech companies could exceed $700 billion in spending on AI infrastructure in 2026, up from approximately $410 billion in 2025. Companies often pursue multi-currency debt to diversify funding sources and manage currency and interest rate exposure, leveraging the demand for high-quality issuers in Japan's institutional market. This shift highlights how hyperscalers are increasingly utilizing debt markets outside the dollar-euro axis to finance massive, multi-year capital commitments. For data center operators and technology finance teams, such multi-currency issuances can provide clearer visibility into long-term project financing and vendor contracting timelines. Analysts are advised to monitor the final issuance size, tenor, coupon structure, and investor reception in Japan, alongside any revisions to future capital expenditure guidance. Noi Dung Kai Tait. Alphabet is initiating its first yen-denominated bond sale, signaling a significant shift in how major technology companies are financing the intense competition in the artificial intelligence sector. This move underscores that the AI race is rapidly evolving from a product launch contest into a balance sheet race, where access to cheaper global capital is becoming as critical as technological superiority. \n the decision to tap into Japanese debt markets, alongside existing issuances in the dollar, sterling, Swiss franc, and euro markets, demonstrates that Alphabet is integrating global debt financing into its strategy to fund the massive infrastructure build-out required for AI dominance. This capital is earmarked for data centers, custom chips, networking equipment, and large-scale model development. \n this financing shift reflects a fundamental change in the financial profile of big tech. Historically defined by robust cash generation, companies like Alphabet have now become industrial borrowers. Training and serving large AI models necessitate enormous capital expenditure on physical infrastructure, land, power, and hardware, a spending pattern more akin to utilities than traditional software firms. Alphabet's updated 2026 capital expenditure outlook has risen substantially, reflecting this focus on technical infrastructure over incremental research. \n competitors are mirroring this trend. Microsoft anticipates nearly $190 billion in 2026 capital spending to support Azure and OpenAI initiatives. Amazon maintains a $200 billion spend driven by AWS capacity, and Meta has raised its forecast to $145 billion as it pushes deeper into AI models and data center capacity. Even platform companies like Oracle are becoming major borrowers due to the need to build capacity ahead of revenue. \n the core of the competitive dynamic is shifting. The contest is no longer solely about which model is superior. It is increasingly about who can finance compute at the lowest cost and deploy it fastest. Access to attractive, cross-currency borrowing rates lowers the friction associated with building the foundational infrastructure that underpins leading AI products. \n for startups, this signals a critical competitive reality. While niche strategies focused on workflow efficiency or proprietary data can still yield success, the funding environment has fundamentally changed. Dominant platforms possess a distinct advantage by being able to finance data centers over decades and negotiate directly with critical suppliers. Startups relying on retail pricing for compute face a significantly higher burden of proof. \n Alphabet's bond strategy is less about Japan specifically and more about the emerging financial architecture supporting AI. The message to the market is clear. The companies with the strongest balance sheets are not just increasing spending. They are building sophisticated financial mechanisms to sustain spending amid rising costs and extended payback periods. The takeaway for the wider industry is that AI competition is now a capital strategy, demanding a convergence of compute access, customer reach, and robust financing. Alphabet is strategically leveraging new financing avenues to fuel its aggressive global artificial intelligence and hardware expansion plans. The company has issued fresh yen-denominated bonds, extending its multi-currency debt strategy previously utilized in euros and Canadian dollars, specifically to fund the construction of AI data centers and supporting infrastructure. This move signals a pivot in funding, increasingly relying on fixed-income investors rather than solely on cash reserves for massive planned capital expenditures in AI. Furthermore, Alphabet is signaling a strong interest in expanding its physical capabilities through potential investments in India, targeting a significant growth market for on-the-ground operations. This combination of multi-currency debt issuance and new hardware-linked projects in India underscores a strategic emphasis on scaling AI beyond traditional software and cloud services. For investors monitoring NASDAQ symbols like GOOGL, the key focus areas will be the execution of these capital projects, the navigation of regulatory landscapes in key markets such as Japan and India, and the interplay between these initiatives and competitive pressures. The success of this AI build-out will hinge on how effectively Alphabet manages these complex capital projects and their subsequent conversion into revenue streams for Google Cloud and related services. Financial analysis suggests that the yen market provides Alphabet access to a distinct investor base and potentially different funding costs compared to European and Canadian markets, offering crucial financial flexibility as spending accelerates across Google Cloud, custom chips, and new AI hardware in regions like India. Investors are advised to closely track the size and pricing of these yen bonds relative to previous issues, alongside management disclosures on debt levels, interest expenses, and the speed at which new hardware projects materialize into revenue. Monitoring shareholder proposals concerning AI energy use, data privacy, and governance will also be essential as Alphabet continues to layer long-term debt to support its ambitious AI infrastructure growth.